Hi guys, in this video, I am going to go over a prezi that you guys probably have already seen, but it's going to just be a quick review of investing because I feel like it's actually been a while since we've been talking about this content. So if you feel confident with the material, feel free to not watch this. But if you would like a brief review, I'm going to buzz through this pretty quickly. I will also make the link to this prezi available so you can watch the videos. I'm going to skip over the videos. You guys can watch those on your own time. So I am going to go full screen with this and click through it just like I would if we were in class. So basically, guys, the stock market is open 5 days a week. It's just like a regular business. It's open 9:30 to 4, and that's in New York. Okay, so it'd be 8:30 to 3 in Chicago. So the stock market basically is just think of it as like a flea market. People come, they're sellers, so those are your brokers, and then people talk to their brokers to buy other stocks, and they talk to brokers, and basically they do like a trade. Okay, you have to find someone willing to sell what they have at the price that you want it, and you go back and forth until you guys come to a price that you both agree on. So basically, the stock market is just a place to buy and sell stocks. Now, the Securities Exchange Commission, which is known as the SEC, basically is the federal agency that regulates the stock market. So, pretty much, they make sure that everyone is playing by the rules and everyone's being fair and that nobody is being dishonest because this is people's hard earned money. You want to make sure that whatever you're putting it in, you feel confident you're not being robbed or taken advantage of. So, if you guys ever see stocks or CEOs or companies being investigated, by the SEC, it is not a good look for them. That means that they have probably done something wrong and that they're being looked into. All right, so really, guys, remember there's only two reasons that companies issue stock. It's either to raise capital, so maybe they want to expand their business overseas, maybe they want to beef up their marketing campaign, maybe they want to develop a new product. So they need to raise money for whatever reason. So they issue stocks to raise capital. Now, remember, not all companies issue stocks. All right, so public companies issue stocks, private companies do not. So some of the companies that you guys may be into and use their products and services, they may not be public and issue stocks. Now, they earn money two ways: dividends and capital. Okay, so dividends is that payout that happens quarterly. So if you think 4 quarters in a dollar, so 4 times a year, stocks give out money to their shareholders. Now, not all companies offer dividends, only some companies do, but basically it could be anywhere from $1, $2, $3, $4 every quarter for however many shares you have. So if you have 10 shares and you're getting $4 in dividends, you're making 40 bucks. So it's just an added bonus, kind of a thank you for investing with that company. It makes them look attractive because they're giving out additional money. So dividends aren't always given out. So that's kind of an added bonus. Now, all stocks, hopefully, if done right, earn capital gain. So they make you money that way. That's just simply selling it for more than you paid for it. So you buy it for $10, you turn around and sell it for 20. So dividends are a nice added bonus, guys, but capital gain is where you're really going to earn those big bucks if you invest properly. Okay, you guys can buy stocks through a broker. You can't just walk into a stock market yourself and start buying and selling. You have to go through that person. Nowadays, there's apps and websites that take out that middleman. But if you're looking for someone to kind of give you financial advice along the way, a broker is the way to go. And then, of course, there's websites that we can use. Oops, sorry guys, let me skip back. All right, there's websites down at the bottom that we can use to learn more. All right, really quickly, there are actual buildings where trading goes on. This is a picture of the New York Stock Exchange. So if you've ever seen The Dark Knight Rises, which is a Batman film, there's a scene where Bane, who's like the villain, goes into the New York Stock Exchange, kind of basically takes it over. This is where it's shot. So you guys can see all these people on the floor are brokers. There's one in Chicago, Shanghai, Paris, Mexico City. They're all over the world. This one you guys probably have gone through in Chicago. If you take 290 into the city, you actually go through it. Sorry. Now, indexes. These are hard at first to understand, but basically, if Principal Manola wanted to know how Lake Park was doing as a whole. So say the state of Illinois asked us, how are Lake Park students doing? And he had a week to figure that out. It would be too hard for him to talk to every single student. What would be more time efficient is if he talked to a sample of students. So maybe he talks to a few football players, people in DECA, he talks to the dance team, he talks to people in speech, he talks to freshmen, sophomores, juniors, seniors. He takes a sample to get an overall idea of how Lake Park's doing. That's the same thing as a stock exchange index. These indexes are set up to measure how the stock market is doing as a whole. It's too hard for them to look at every stock. So there's three big ones that were made. The Dow Jones, which we've already talked about, tracks 30 stocks, okay? Now these are what they think are the most well-known companies. They say these stocks are domestic, so they're all US based, they're well-known, they're financially sound, they perform well. So these are called blue chip, and there's 30 of them. So people usually say if the Dow is up, stocks are up. If the Dow is down, most stocks are down. Now, it's not always correct, but it is a pretty good indicator of how the overall stock market is doing. And these are the 30 companies, which I'm sure you're familiar with some of them, that are on the Dow. Okay, so the most recent one, I believe, was Walgreens. Sorry, went over that a little quick. The S&P 500, I'm not going to go over. This is 500 stocks that they put into kind of a basket and watch. These are not the most popular, but they're the most widely held, meaning the most people have them in their portfolios. And then the NASDAQ, guys, just tracks 5,000 other stocks. It used to be just technology, but now they have a little bit of everything. All right, we're getting towards the end. I am going to skip over common versus preferred. This, again, too, it'd be awesome if we were in class so I could really dive deep into this, but it's not that important when I'm doing this quick review. All right, this I know a lot of you understand. Bull market just means the stock market is over or is up in general. Most stocks are up, where the bear market means most stocks are down. So just think of a bull's horns driving prices up, where a bear's claws are slashing prices down. So it just means overall. It doesn't mean every stock, but a majority are going to either be up or down. Okay. And last but not least, I'm not going to go too deep into these guys, but income stocks. Okay, there's 4 types of stock categories, and I really do want you guys to understand them, but I understand that if it's a little difficult at first. So income stocks, guys, these are just companies that pay dividends. If you look at a company and it pays dividends, it most likely is an income stock. So what they do is they like to keep their customers happy. They like to keep the people, their shareholders, happy. So they pay a high dividend. So some of the companies you see on the screen are companies that do just that. Now, if you don't pay dividends, you may be a growth stock. And what a growth stock is a company that doesn't pay out dividends, but rather takes that money and reinvests in themselves so that they can grow better, faster, and stronger. And that still is attractive to shareholders. Okay, so while they may not be getting dividends, that company is growing bigger, better, faster, stronger. Now, we're familiar with blue chip. Blue chip is those 30 stocks. And if we were in the classroom, there's some posters in the classroom of just blue chip stocks. So they're safe. They're in good financial shape. They're leaders in their field. They're well established. The ones at the bottom are some examples of that. Okay, and there's 30 of them. And then last but not least is cyclical. And actually, given what's going on in the economy right now and actually in the world in general, there's a lot of companies whose stocks are plummeting because they could be considered cyclical. So what cyclical means is they're sensitive to the overall economy. Okay, so if the economy's down, they're most likely down. If the economy's up, they're most likely up. So if you look at the 4 stocks on the screen, you have United Airlines, Ford Motor Company, Caterpillar, which manufactures construction equipment, and Royal Caribbean Cruise Line, which, you know, as crazy as it is right now, is probably not doing that well. So these are all companies that if people have money, they're most likely using, taking flights, buying cars, doing construction, going on cruises. But if they're associated with things that we don't use when we don't have money, then they're not doing that well. So these are just performances strongly tied to the overall economy. All right, and I'm not going to be going over a stock quote in this video. There may be a future video to come, but what I want you guys to understand is when you guys buy a stock, okay, you become part owner of that company. All right, you're not a huge owner. You can't just like walk in there and start ordering people around, but just know that you have ownership. So if that company does well, you do well. All right, so that's why they offer stocks. You give them money in the hopes that they're going to increase your investment. And if you no longer want to be owner of that company, then you sell your stocks off to somebody who does want them, or you can even sell them back to the company. So that's just how they work overall. I'm hoping that you guys, all of this was a review and none of this is new to you. Please feel free to email me with any questions. I will make this Prezi link available so that you guys can review it. But I just wanted to kind of go over that to give you guys the basics back.